All right, the Russell 2000 continued its remarkable run over the past 5 days, really since the CPI report came out last week. It's been on this outstanding, pretty much a historic run. And we'll show again, just like we did kind of yesterday, there's additional indicators that have just reached historic levels, like levels that we haven't seen for the Russell. So, one of them, the levels we haven't seen ever for any index. So we'll break all that down in today's video and just kind of show just how bullish it is and what we can expect after such a big bullish move like that. What kind of move did we have preceding it, and how does that influence the type of move that we've had, and compared to other times we've been pretty bullish, including the end of 2021 that we've used quite a bit as an analog for the current price action. We'll break down how the sectors have been performing in relation to that. Very, very predictable. Again, how long can a move like that last and still maintain such a bullish sentiment with the essentially the wrong sectors leading the way higher from a cap-weighted standpoint. And then we'll take a look at our trade, another stock and at least related to the home builders that have been doing so well. We've had a recent market outlook trade in the home builders sector. This stock is related to that and also kind of doing well, breaking out some resistance that I'll point out. And we'll talk about how to trade that stock on that breakout, similar to some of the other breakout trades we've done here over the past 5 days. So let's go ahead and get started. Today is Tuesday, July 16th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. If you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. This is where I would take a look at all the old trades we've done, see if there's anything new, anything we need to close out. We also put on today's trade idea already before the market closed. Coming down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click that thumbs up icon and hit that like button. Again, the more you do that, it helps get our content out to all of our followers on these platforms. Again, thank you for those who do that day in and day out. Those who don't, you can do right now while you're watching. Help us get to our 100 like goal here on Twitter. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we rallied again today, 52-week high as well as a 52-week closing high for the S&P 500. But this one's a little different in that the near-term line did not get into the upper reversal zone. So last night we talked about, again, it takes 2 days to go from below 40 to above 80 if you want it to be a high probability of being a bullish near-term peak, one like this. Or a near-term peak like this, which was not bullish, and we did not get to new highs and ended up going down. Now, granted, fortunately, it went down to another bullish near-term low point, and that's great because, again, it's the same thing works in the other direction. It takes 2 days to go from above 60 to below 20 to produce a bullish near-term low point, and we haven't seen that. You can see the last time we kind of saw something like that was over here, where we went from above 60 to 2 days, eventually a third day right there to get below 20. And we actually had a bearish one over here as well. So, and that came off of a bullish peak. This is the one that really is the one that ultimately turned from a bearish peak down to a bearish low. So the idea of this being a bearish low high point is there, right? Because we're still not above 80, and there's a chance that we can drop tomorrow on this. So it doesn't mean that we can't go up above 80 tomorrow. There's still a chance that that can happen. It's a low probability. It's not a 0% probability, but it is a relatively lower probability. So that's something we need to kind of keep an eye on, especially because, again, the momentum line yesterday was below the near-term line. If the momentum line was, say, right here, then there'd be a good chance, right? But when it's not, when it's lower than the near-term line on that first day out of bearish territory, that's not a good sign. And we saw that so far today. So far, at least. It's a very small range, very low volume day today, at least, again, only on the S&P 500. We'll take a look at the Russell 2000 here in just a second. We are 3.5% above the moving average. So, again, that's a pretty decent level if you use 84th percentile. Not quite the 90th percentile, but still pretty high, pretty strong. As you can see, one of the higher levels of the past year, or to zoom out here, there you go. So one of the highest levels of the past year. You have to go out to this first surge that we were above it, right? Coming off of that Halloween low point there from 2023. 2023. So, of course, this is following the NASDAQ. They're very highly correlated. You can see the NASDAQ looks a lot less bullish. This is the first day of outside the bearish territory for the NASDAQ, and you can see the momentum line is definitely not above it, not even close. So again, very good chance that this ends up forming a bearish peak, and we just turn right back down. So something to keep an eye on there. As we had this, it's kind of like this happens quite a bit where you get you have a big trend, you get a reversal candle that's relatively large. And I'm sure there's I know there's a name for this. I never know all the names of all the candlestick patterns. I just know the obvious ones. But the principle is you get a big reversal candle. Then you get some, higher days. I mean, we rallied all 3 days. Some higher days that fit all inside of the range. And then usually it's a continuation pattern, a reversal pattern here. In this case, you get another big candle to the downside like you did here. So that's a possibility tomorrow, especially considering, again, the momentum line being so much lower than the near-term line is on that first day out of bearish territory. Now let's take a look at the Dow and the Russell, because that's a much different story. The Dow Jones Industrial Average, you can see, has a strong bullish posture, intermediate line above the 90th percentile. The near-term line also, we're also got a bearish near-term rally going, a very good strong move here, up almost 2% today. So big rally, up 4.5%, which is the 87th percentile. Again, only this surge over here had higher, so it's a pretty good strong move. And market sentiment now is crossed above the 60th, so it's into bullish territory. So very good move for the Dow Jones Industrial Average, and an even better move for the Russell 2000, which went up 3.5% today, now up 11.5% over the last 5 days. The intermediate line almost to the 90th percentile there. The near-term line very, very high. We are in the 97th. We're 10% above the moving average, which is the 97th percentile of the past year. If I go out to the last 5 years, it's not quite. It's in the 86th percentile. You can see only coming off the COVID low did we get further above the moving average. You can see a lot of these other instances here in, what would that be, August of 2022, we were 10% above, and that ended up being the peak for that move. You can see right here in 2023, we got to 9% above. That ended up being the peak of that move. And then, as you saw over here, we ended up getting 8% above, so 10.5% above, and it wasn't quite the peak. We went up a little bit higher, but you can see we were flat from that point multiple months later. So getting to 10% is kind of a magic mark it's kind of like 5% for the S&P, 10% for the Russell. It's kind of where you stretch that rubber band out a little too far, and eventually pops back. So something to keep an eye on for the Russell, especially considering how significant this move has been in the last 5 days. In fact, if you look at the daily price move here, you can see the S&P has been positive. In fact, it's kind of interesting that you've had 8 days in a row of gaps to the upside on the S&P 500. Here's the Russell 2000. You've also had a lot of good. In fact, you've had 4 days in a row of a standard deviation or more of a gap to the upside. This one was a big one, but now you've had 2 out of 4 days where you're up. 2 out of 4 days where you're up 3% or more, and you had all 5 days that you're up just about 1% or more. You're at 0.98 there, 1.16 here. So very significant move that you just rarely see. Again, you rarely see 4 or 5 days in a row of 1% or more. You can see it. There's a few here and a few there and a few there. And usually when you do get these kind of moves where you get so many days in a row of 1% or more, they're usually coming off of major lows. You'll see here in a second. But you can see we're not coming off of major lows here. So if I were to look for other periods of time, you can see a lot of 3s in a row. And, again, coming off of some lows, and after some drops came after that. You can see in the last, this would be the last 5 years. This would be one of our closest periods of time in 2021, and you saw the big drop we had previous to that move. Here's another period of time in November 2020 with the reopen. This is the post-election trade again, coming off a period of pretty significant declines, and we were close to 1% 4 days in a row. Even coming off of the COVID low, we didn't quite have 4 days in a row of 1% or more, though we came pretty close. So it goes to show how rare this move is, how significant it is, especially considering we had very minimal moves to the downside heading into that rally. Very, very minimal moves. All right, now let's take a look at the weekly chart. As you can see, very strong candle to the upside. Look at the Russell's weekly chart. Big time candle. Again, one of your bigger candles that we've seen in a long time. The biggest candle that we've seen in the last 5 years. Now the week's not over with yet. We're only 2 days into it. Last 3 years, excuse me. If you were to go back 10 years, let's see here. Let's put that horizontal line on. So we'll put it right where it's at. So right about in that range. So you can see, that was a big candle. You really have these candles here. Post the reopening trade was our biggest move that we had, biggest candles that we had, and then also coming off of the COVID lows. You can see another period of time here coming off the election. We also had November election, a big candle this size that kind of started a rally after a pullback. And we already were bullish. We had a little bit of a pullback and then started the rally. Something very similar to what we have here now. Let's take a look now at the 3 green arrows. Of course, you do have 3 green arrows across the board. The Qs still have the red arrow on the MACD, so it's still in convergence mode. Everything else is still bullish. You see the Russell and the Dow over here. Look at the Russell in big volume, 4 days in a row of 1.5 times the average volume. Big extreme again, so extreme range, especially when you include the gap. We'll talk about that in a second. And big volume, those are extremes, and you usually don't want extremes. You prefer that they're kind of slightly above, slightly. You get a black arrow, but just slightly above it, and you get range significant, higher than average ranges, but not so strong. Remember, this is not even including the gap. There's still a from close of 217.19 to a low of 219. So you're looking at about 1 3/4 points that you add to this. So you're looking at about a 7.5 point range versus 3. So I mean that's an extreme to the upside, as I'll show you the averages here in just a second. From a 2-line basis, very good S&P 500 chart. IWM is even better, right? Look at how strong that MACD is. Again, one of the stronger levels on that MACD that you see, way up above some of these short-term averages. So if you look at, for example, how far above the 17-day exponential moving average we are right now, you can see it's pretty high, 9.5% above the 17-day exponential, which again, it's the highest of the past year. It's the highest going all the way back to some of these levels back in June of 2020 and also April of 2020 here, before you can see some at least short-term declines back towards those moving averages. So very, very extreme move. You take a look at the DMI, you see that here as well. I tweeted this out earlier today. This is the highest level that this was where my cursor was. But now it's even more, the highest level that the positive index has ever received on Russell 2000. The S&P, its negative indicator has dropped below 7 now. So you see its negative indicator is at 6.67. Again, orange arrows. The ADX is almost a 47. So very extreme parabolic move even on the S&P 500, even though it's really slowing down. Its RSI and CCI are still both very strong, especially on a weekly basis, up to almost 80, 79. But your Russell 2000 is really taken off. So this is the highest level for the RSI and the CCI since this week, right? The fake out week of November 2021. So we really want to avoid this being a fake out pattern. It doesn't have to start off big. You can see kind of built up, the fake out kind of built up week over week. So we kind of really want to hold this and build. If you look at the daily version of this chart. Big time move above 80 on the RSI. Like we just don't get that high. We haven't in the last 5 years. We've never been that high, and we might not. Let's see if there's ever been a time that we've been above 80. So yeah, there was right there in 2017. We are above 80, and you can see, we still rallied, but a 1 year return later to October, and you can see we are flat. And even to October, 2 years later, we are flat through ups and downs before finally breaking down there in 2020 and beyond. So it's rare to get above 80. As you can see, it's very, very rare. Here's another instance back in 2003, coming off of a bear market low point, no less. We got above 80. In this case, not only did we get above 80, but we also got above 300, which remember I told you yesterday, that was the highest CCI level it's ever had. Again, going to show just how rare this move, how historic this move has been. Looking at the Ichimoku cloud, very mature trend going on here. The IWM has now reached mature levels. So went from no trend 4 days ago, where we had zero because we had stopped whatever bearishness we had, but we were at zero. So to go from zero to mature in 4 days, I'd have to go back and see how often that occurs. But I would venture to guess that is a very rare thing. To go from zero, literally zero on both these indicators right here, to zero to then being above 5 and above 80. Usually it's a buildup, right? It's a buildup, and this was hardly a buildup. And the rate of change over 26 days, again, one of your higher rate of change levels for the Russell 2000, 10%. Again, we were about that high over there, but definitely, again, one of the higher 5-day moves, and especially one of the higher 4-day moves that we've seen ever for the Russell 2000. Let's take a look at the Ichimoku cloud. The Bollinger Bands. We are, still above the Keltner channel in the S&P. Still have positive momentum. We're still at the 99th percentile of the bandwidth. Of course, IWM has also reached something it's never seen before. So look at the bandwidth. It's gone from extreme low up to boom, up to 12, which is so high. Like, again, let me just give you some perspective on this level. It's not the highest, as we saw over here, but if I put my cursor there, you can see it's a pretty decent level for the Russell 2000 on the bandwidth there. So big move, but this is, if I were to do this Bollinger Bands on the 5th, and we do it right here on the 20-day exponential moving average. If I were to do it on the 50-day simple moving average, we have reached the highest percent B down there. See if I were to do the percent B on the 50-day simple moving average. It's reached 160. This is the highest level. Let's see, one more day. Right there, 160. This is the highest level the percent B has ever been for the 50-day simple moving average. So how far above the upper band we are on the 50 days. So if I were to go up here, just so you can see that upper band up there. So we'll go 50-day and we'll do simple. So this is the furthest above that 50-day moving average, that upper band on the 50-day moving average that we have ever been for any index. For any index, major index. That's how historic this move is. So big, tremendous move. Of course, you're getting a higher high and a higher low. You close pretty much right at today's high and yesterday's high on the S&P. Obviously, for IWM, that wasn't the case. We exploded here with more, and it kind of looks like a runaway gap in and of itself. Obviously, you have a good bullish pattern there in IWM. The 4-week range has exploded as well up to the upside, similar to the Bollinger Bandwidth, as you have a very bullish pattern here. I showed you the ATR and the price, still very low and back below 0.8%, which is extremely low for the S&P 500. And the volume, again, remains extremely low for the S&P 500. IWM, this sucker has exploded. Look at that range. So again, it's very rare for this to go up because of a bullish move. Usually this goes up as we're bearish, especially with the average volume as well. And so, but this has gone up on a bullish move. So keep in mind, again, as it falls, there's because you're already really low. relatively speaking, if you look at my cursor, even with today's move. So if it starts to fall, you have less room to fall if we're going to maintain bullishness. Because if we're going to maintain bullishness, these two have to start falling. If they keep going up, that means we've reversed this move when we started the move to the downside. Let's take a look at the volatility index, the VIX. Not really moving as much because remember, this is a small cap story. In fact, it actually moved up today. The correlation of the S&P 500 with the VIX is at very high levels. Looking at the VIX here, is at positive 88%. Again, it's not very common for it to get this high. And it usually, when you've been bullish, it usually gets high at the end of your bullish moves. We saw that over here in 2018. The VIX, we had this good, nice little run, and the correlation of the VIX and the S&P got bullish over a 2-week period at the end of that move, just in time for the VIX, boom, to move higher. And again, we are expecting the VIX to have a pop-out move similar to what the Russell did. We're expecting the VIX to, and you can see the VIX is above its average values over whatever time frame we look at. So it is starting to creep higher, even if it's not necessarily high yet. If you look at the VVIX here, you can see we are above 80 still. We're still above 80, and it's also creeping higher above its average values. Not quite breaking out yet above its 200-day average value, which would really set us off to the upside on volatility. All right, now let's take a look at what's driving this price action. Look at this returns over the past 3 months. The Qs have always had outpacing returns, and IWM had been lagging until the last 5 days. Now they are both right next to each other in terms of 3-month returns. The dollar is down. In fact, if I were to go to the last 5 days alone, let's take a look at the last 5 days. So post CPI. Here, let's zoom out a little bit to like a 15-minute chart. You can see IWM is up 11.5%. Real estate is doing pretty well. That's kind of an unreported segment of the economy that's been doing really well. I guess home builders have been kind of lumped into that. Gold is up 4% in the last 5 days. That's an interesting pattern. Even with commodities down a full percent, the dollar down, but not down that much to warrant a 4% gain in gold. And you can see TLT is up, which means yields are lower. Yields continue to be lower. If I were to take a look at TNX, CGI, you can see back down today. So closing at its lowest close since way back over here in March of this year, when we had a little bit of a drop in the yield. So 4.16%, intermediate lines down, near-term lines and momentum lines still in bearish territory. So still really bearish move on yields, which is really propping up a lot of this move right now. And, for that matter, relatively bearish move in the dollar. Obviously, the first 3 days of this 5-day run, the dollar really dropped pretty sharply. In the last 2 days have been kind of settling down in this 104 area. Just for some perspective here, this 104 level where we're at right now is still, even with this pullback from where we were, is still a higher level. So here's 104 than any level we had since, as you can follow my horizontal line across all the way to, it was about as high as we got after the election of 2016. But it was, you have to go all the way back to the late 2002. And I tweeted this out because there is some chatter here about a new administration bringing the dollar down. So here, let me bring this over and share this with you so you can see it. About a Trump-Vance, I don't know why this isn't logged in, a Trump-Vance administration bringing the dollar down. But as you can see, like, generally speaking, the dollar and the S&P 500 have a negative correlation. This is a 1-year correlation out at the bottom. They generally have a negative correlation with each other, but not, as you can see, not always. Now, most of the time that you see they have positive correlations is because they're both going up. Most of these periods, both the dollar and stocks are both going higher. That's the case for most. There are 2 instances, though, where the dollar and stocks both had a positive correlation, but they both went down. And that was in 2002 and 2007 to 2008. Both those instances obviously being bear markets there. And when you consider that the CAPE ratio right now is up, 36.5. I don't know if we necessarily want the dollar to go down if it transitions to a positive correlation, again, that would suggest that we're going to be coming off of, a high. This is a really, really high CAPE ratio. Again, 2002, we were also coming off of a high CAPE ratio. It was much lower than where we're at right now. In 2007 and 2008, about the same levels. So this is a much, much higher level for the CAPE ratio. So that's something to keep in mind if we are anticipating and kind of hoping for weakness in the dollar to kind of propel stocks forward into like 2025 in case of a new administration. It doesn't necessarily mean that we're going to be bullish over that time frame. Here's where the dollar is. Again, why you can see why we're kind of holding this 104 level just under the 200-day moving average, and we'll see if that ends up holding for good by the time all is said and done. Obviously, the breadth has really exploded here. We're almost back above 500 on the summation index. That's how fast we moved up here to 84 on the McClellan oscillator. When you look at the new highs and new lows, they have also exploded. The number of stocks above the 50-day moving average busted up well above 300, above 350, almost to a 90 or 80% level at 400. We've seen this before multiple times, but this is a very, very strong move. Very big 5-day run. Remember, just 5 days ago, we were below 50% and pretty flat in this neutral range. What's interesting, too, about this is that number 384 is now higher than the number of stocks above the 200-day moving average, which is what you see here. We have dipped below 1. Now we dipped to 95 over here. We got to 97.3 actually right there. On the lows we got to 95, but here we got to 98. So here we are again at 97. So are we going to kind of hold here, 96.8 actually? Are we going to hold here and bounce? And if we do, that would be bearish. Or can we continue even lower, which, as you can see in the past, is generally pretty bullish. Now, granted, all these other times we've dropped below 1, we haven't been as bullish as we already have been. Remember, keep in mind that we are currently on a 14% rally. So it's not like we're coming off of a low point right now. And generally speaking, when you break one, you are either coming out of a convergence period, like we were right here, so we had some room to run up, or we're just coming right off of a low point. Right off of a low point, we had lots of room to go higher. And so that's something to keep in mind in terms of over here as well. You had dropped below 1 right when you were coming off of a low point. Over here we dropped below 1 and we had already been bullish for a while. So it sounds pretty familiar in this particular case. I mentioned the new highs and new lows exploding, got up to 900. We haven't been above 900 for years. Multiple years. So very, very strong, explosive, extreme move on the number of new highs and new lows, on the number of highs minus new lows on both the New York Stock Exchange and the NASDAQ Composite. So again, we haven't, this is a big, big time move. Usually, again, it's something you see when you're coming off of a low point. You get these big surges when you're coming off of a low point. When you get these big surges like this, in this case above 600, when you've already been bullish, again, we've seen what happens, right? We've seen what happens over here in November 2021, another analog to a big spike in new highs and new lows when you've already been trending bullish for a considerable period of time. Here's the ratio of the Qs relative to IWM, breaking down hard today, well below the 50-day moving average, way, way below. We had gotten below it yesterday a little bit. Today, big time drop. Still not below the 200-day, and you can see the long-term PPO is rolling over. Remember that this ratio is actually positively correlated on a daily chart, and is definitely positively correlated on a weekly chart with the S&P 500, even more so on the weekly chart. So again, probably not something we want to break below these 200-day, in this case 50-week moving average, and in which case, again, we've done this before and we were okay, but we had a negative correlation at the time, and we had the reopening trade, right? The economy was literally shut down, holding back a lot of these smaller cap type industries and sectors, but allowing the mega cap names, which can still flourish in a at-home economic environment. But once the economy reopened, then you can see why. But we didn't get below the 200-week moving average. But here again, we are pretty far up above. The gap between the 50 and the 200 are pretty high. If we were to break that, I mean, it's great to go down to it. There's been multiple instances where we moved down. In this case, moved back to the 200-day moving average. It's great. We can move to the 200-day moving average, just like we saw late last year, and still be bullish, right? But what we can't do is break the 200-day. We don't have a reopening trade to look forward to be able to have a negative correlation for an extended period of time. So, this is okay. And this has given us room for the Qs now to regain their leadership and bounce back up and probably a lot slower, but bounce back up towards 245 and establish more of a trend up here. So, because it had been parabolic. So this has given us the ability to do that. If we continue on this, it's probably not going to be the best scenario for stocks. I mean, 2.2, as you can see, is a pretty significant number, just on it, regardless of averages, just on its own basis. We hadn't gotten above and stayed above 2.2 for very much. It had been a pretty significant resistance. As of right now, holding for support. And a break of that level probably, at least according to the correlation, would not be bullish for equities. All right, let's take a look at the sector rotation. Of course, you can see the same time frame that IWM is just absolutely killing things. You can see what's been doing pretty well. So again, XLK 3-month, XLK, XLY, still killing it. XL utilities and real estate also doing well, interest rate sensitive areas. Industrials, materials, energy, still really lagging despite a really good return over the last 5 days. But again, it goes to show why they've done so well, because they were so oversold. That because they were so oversold, they can rally 5.5%, 4%, and clearly outpace XOK and XOC over 5 days. But because the reason why they did that was because they were so oversold on a relative basis, on a year-to-date basis, right? Going into right here 7.9 from this point forward, you can see. We were up to 20% returns in XLK and XLC, but, in some of these other, we were only 10%, so half the return on XLF. XLI was only at a 5% or 6% return. Materials was only at a 2% return. Energy was only at a 6% return. So significant underperformers that are actually still underperforming despite that recent rally. But again, as you can see, as I told you before on this chart, we were the IWM was just on a very oversold technical basis on a relative basis to the Qs. We were up in here, so very extreme to the upside. We had been talking about that divergence playing out. Well, did it play out in a big way? And that's really all it's done. It's just resolved an extremely oversold technical situation, and now it will most likely allow for a move like this to occur again, where Qs take off on a much slower basis than what we've seen the last 4 days, take off and fill in these gaps and get back above those averages. Because if not, then we're in trouble, right? Then we're in trouble there. All right, let's go ahead now and take a look at Home Depot. So we'll pull up the market forecast chart. This is our trade of the day. Home Depot, as you can see, nice good bullish pattern, intermediate line crossing into the upper reversal zone. Market sentiment line's pretty low but still rising, 7% above, which is not very strong. It's not too high. It's strong, but it's not too high. It's in the upper quartile, obviously. And then you are dark green shading and a green line, so that's a nice good move to the upside. Take a look at his weekly chart. You can see a nice good bullish candle after a transition candle lasts so many weeks. Back to a green line, transition this week. PPO is rising at low levels too, so again suggesting that we might be just starting a new run. Obviously you have 3 green arrows here for the last 4 days, starting off with above average volume, which is how you would like to start off a new trend to the upside. All the moving averages are sitting on top of each other, and now they're starting to extend away. You're above the 8 and 17 are above the 30. You're now closing above the value area. So that's a nice good sign, a little bit of a resistance there. We could be getting above. Looking at some of these other oscillators, you'll see that We're above 40. We're above 30 is the key, but we're above 40, and we're below fit 20. So the ADX still hasn't even crossed 20 yet. So again, another sign we may be just starting a move here. Both the RSI and the CCI are good, strong, bullish levels, just like we want to see when you're starting a trend. The Ichimoku cloud, we just barely got above the cloud. Today is our first day getting above the cloud. We have almost an intermediate trend strength going. You have to get above 2 and above 65. So we're almost there, but you have a very strong rate of change. The green line is above the blue line. They're both rising, so that's a good sign as well. And then finally, looking at the Bollinger Bands and the Keltner channels, you'll see that you're above both the upper band and the upper Keltner channel. Bandwidth is rising. The momentum is just turned bullish. You got green dots. So looking pretty good for a bullish trade opportunity. So what I decided to do here was to do a long call vertical spread, selling the mid-30s delta, buying one strike away. So a little less aggressive. Although usually we might go out to the 20 delta. But this is a little bit less aggressive because we're so bullish. I want some more flexibility on the timing. I don't want it to have to go up today or tomorrow, or I want there be the opportunity for some pullback just in case. So that's kind of what this is. This, again, the stock can move up. You can see the stock can move up, and we're still in that zone, or excuse me, down. The stock can move down. Sorry. You can see we're still in that zone. Time can pass. And we still have some time, right? We still have some flexibility as long as the maximum gain is inside of 1 standard deviation for this trade still to work out. So that's kind of the idea why we went a little less aggressive than what we've done here recently to buy or sell. I mean, still a pretty good return, about a 1.5 to 1 reward ratio. So, less risk than our normal typical bull put spread, but a better return, much better return than about 3 times the return. We usually go for $300 for $1,000 of risk, but we're getting $900 for $600 of risk. So, but there's a lower probability, but still a lot of flexibility, and that's kind of what we like on this trade. All right, well, that does it for today. You've heard from me. Now I want to hear from you. Use that link popping out on the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Tuesday night, everybody, and we'll see you all tomorrow.